Now, what I'm going to talk about is year-end tax planning. I always tell people I thought there were three for sure things where I was going to be able to tell you. Number one, I figured we'd know what the new tax law was going to look like, and that didn't happen. I figured COVID would be open, and that didn't happen. And I figured the Browns would be a good football team, and that didn't happen. So, a lot of the items that I was going to discuss just didn't pass. The proposal that initially was set forth by Biden was going to make major changes in the income tax rules, the estate tax rules, IRA rules, and just everything was going to be changed. Very few of those proposed changes have lasted in the version that was passed the House. Again, we have no idea whether that's going to pass the Senate because of all the political issues that you're all aware of, and we'll just see what happens. So I'm going to talk about some basic income tax planning that really hasn't changed over the years. So number one, and again, I'm going to email this outline out to you all after the seminar. It might not be today. It'll probably be the beginning of the week, but because of the holidays. So number one, you should look to accelerate your deductions before the end of the year. So for example, everyone right now has a standard deduction as an individual of $12,550. A married couple, $25,100. So what that means is that you don't need to itemize until you get above the let's say married couple $25,000. So it's for most people nowadays, they're never going to itemize. Those are plenty of deductions. But if you think you're going to get close to that, then you need to think about accelerating your deductions. Also, by the way, if you're over 65, you get another $1,350 of a standard deduction. So what you need to do is look at all your deductions right now, pretend you were doing your tax return right now, then see if you get close to this $25,000 number. If you do, then consider accelerating the deduction. So your state income taxes that are due, if you pay your taxes that you might be owe for the year 2021, pay it before the end of the year, or your city income taxes, if you have those, and your property taxes, you're allowed to deduct those up to $10,000. So if you're below the $10,000 amount and you think you're going to be near the standard deduction, accelerate it. Now, if you're paying a mortgage, you're kind of governed a little bit by what the mortgage company does, the bank does, and they sometimes don't pay that last payment until January. You can actually call them and they'll accelerate the payments. So consider that, or you can just make the payment on your own, especially the property tax, just pay it on your own, which you can do. But if you're close to that amount, see if you can get up to the $10,000 amount. Same thing with interest. If your payments are the beginning of January, technically you owe the interest for December. You can actually pay it by December 31 and get the interest deduction in 2021. So consider doing that. You can accelerate your charitable deductions. Now, if you're going to make a contribution to charity, do it before the end of the year, obviously. But if you're going to be charitably inclined over several years, consider setting up, a special fund called a donor advised fund. You're allowed to put money in that to get a charitable deduction this year, but have the money bleed out to the charity over many years. Most of the brokerage houses have those, Fidelity, Vanguard. So you put your money in there, you invest it with Vanguard still, let's say, or Fidelity, but you get an upfront charitable deduction now, and then you bleed those payments out over several years. If you have a capital gain asset, stock, you can take advantage of that, put in the stock in this donor advised fund, and then you sell it inside the donor advised fund. You don't owe any income taxes on that. And then you get a charitable deduction for the entire amount. So it's a good tax tool. Again, if you're charitably inclined. If you're not charitably inclined, don't do it. Medical expenses are much more difficult. The medical expense deduction, it's only if you exceed $7,500. So, 7.5% of your adjusted gross income. So if you had like $100,000 adjusted gross income, your medical expenses would have to be in excess of, let's say, $7,500. So if you're near that amount, near that 7.5% amount, then make some doctor's appointments. Pay your medical expenses this year before you slip over to next year. And then finally, consider a 529 plan. Ohio has it, not the federal, but the Ohio has a deduction of up to $4,000 per beneficiary. Now, that's not going to save you a fortune. You know, it may save you a couple $100 of Ohio income tax. But if you're going to do it anyway, if you're going to make a deduction, if you're going to make a contribution anyway, then you might as well make it before the end of the year and reduce your Ohio income tax. Now, before I go on to the next topic on that, any questions on that so far? Okay, so the next question deals with IRAs and 401ks. And by the way, as you know, you can make it, if you can, no matter your age now, you can make an IRA contribution if you have self-employment earnings or you have a W-2 salary. It used to be you couldn't make any contributions to an IRA once you were 70 and a half, but that law was repealed around a year or so ago. I can't remember the exact date. So you can contribute up to $6,000 for 2021 by April 15th of next year. So you could wait till next year to do this. And if you're 50 or over, you can throw another $1,000 on top of that, or $7,000, and that'll reduce your taxes. Now, some people can't make a deductible IRA contribution because even though they have salary, maybe they participate in another plan and their income's too high, or their spouse participates in another plan and their income's too high, and they can't make a Roth contribution because their income's too high. Consider making a non-deductible IRA contribution. It's not a Roth, it's still a traditional IRA, and that grows income tax deferred. You don't get a deduction for it, but then convert that non-deductible IRA into a Roth. It's called a backdoor Roth, many people call it. And that's a great tool to use if you have too much money and you can't make a deductible contribution to an IRA. You can convert it. Now, the downside is you can't pick and choose what you convert. So if you already have, let's say, $500,000 of traditional IRAs and you contribute to a non-deductible IRA, you can't convert just that non-deductible portion. You'd have to convert a pro rata portion or all of it if you wanted to contribute, change that to that recent contribution to a Roth. So it has its drawbacks, but it's something to consider. Any questions on that? Okay, so I'll go next to capital gains and capital losses. If you have any capital losses, consider selling this year, getting out of that capital loss, and then using that capital loss to offset any capital gains you have. So if you have stock that you have and you want to get rid of it, a capital gains stock or capital loss stock, then sell the capital loss stock, and that gives you something to offset the capital gains and any gains you might have. Or maybe you have mutual funds that are going to be generating some capital gains. So take advantage of your capital losses. If you like the stock, you think, I don't really want to sell this stock. It's dropped in value, but I know it's going to take off. You can sell the capital loss, get your capital loss, and then you wait 31 days and you can buy that stock again. Or, maybe you buy that stock in your IRA, and that won't be a wash sale. And what they want to do is they don't want people to sell capital losses, immediately buy the same stock again within a window of time. But if you get past that window, you can go ahead and buy the stock again. It's called the wash sales rules. But you could sell stock individually and then buy that same stock with your Roth IRA, your traditional IRA or Roth IRA, and it won't be a problem. So take a look at all your investments, and if you have capital losses, consider harvesting them, taking them now and getting those losses and offsetting them against capital gains. Also, if you have too many capital losses, let's say you have $10,000 of capital loss and only $6,000 of capital gains to offset them, you have $4,000 of extra capital loss, you can deduct $3,000 of that against ordinary income, and then the remaining $1,000 will carry over to the next year. And the carryovers last forever, so you don't have to worry about them expiring until you use them up. And finally, if you're in a low income tax bracket, if you're a married couple with income less than $80,800, single person $40,400, there's a zero capital gains rate when you sell your stock. So it depends how much you sell, because you could blow through that limit. But consider that you can sell some of your stock at zero capital gains. So you should look at that very carefully. Gives you an opportunity to get out of a position if you're concerned about it, or even sell it and rebuy it, because there's no wash sale rule there. So you sell it, get your basis higher at no cost to yourself, and then buy it back again. Other than the commissions, you're in good shape. So think about that. Look at your capital gains and capital losses and make some decisions before the end of the year. Any questions on that? Okay. We'll go to charitable gifts. Maybe you don't itemize. Maybe your income is, your deductions are well under the standard deduction. You're still allowed a above the line deduction for charitable gifts, $300 for an individual, $600 for a, excuse me one second. $600 for a married couple. This is above the line deduction, but you need to do something. You need to make sure you do that contribution well before the end of the year, because the check should be cashed. You want to make sure it's not sitting there in some charitable account somewhere, even though, you want to make sure the check has gone through the system. Now, theoretically, the IRS should not make that argument. If you write the check on December 31 and drop it in the mail, it should be a deductible expense, charitable deduction. But you don't want to be in that argument if the check is, the US mails are 2 weeks to get to the charity and the charity sits on it for another couple of weeks. And all of a sudden it's a month later, it's going to look like you backdated a check. So you don't want to do that if you can avoid that. Next, I'm going to deal with IRAs. As you know, the required minimum distribution date changed to age 72. That was last year's law, the Secure Act. However, there's a special rule for charitable deductions from IRAs, and that still remains at age 70.5. At age 70.5, you can transfer up to $100,000 from your IRA directly to a charity and get some tax benefits. Now, remember, this only makes sense if you're charitably inclined. If you're not charitably inclined, don't do this. But if you're charitably inclined, you can transfer up to $100,000 from a traditional IRA to a charity, and that will not be included in your federal income tax. And also, more importantly, it won't be included in your Ohio income tax, because Ohio, you don't get a itemized deduction. You pay it based your Ohio income tax basically based on your adjusted gross income. So if you make a charitable contribution with an IRA by having to go directly to the charity, it won't be part of your Ohio income tax. You'll save Ohio income tax. Additionally, by using this device, if you are required to make required minimum distributions, let's say you're past age 72, this counts towards your required minimum distribution. So if you are charitably inclined, you can contribute directly to the charity, avoid the income tax at the federal level, avoid Ohio income tax, and apply some of that to your required minimum distribution, which for some people is a great tool. Additionally, by using this tool, as you know, if you're on Medicare, if your income is too high, your Medicare premiums go up. If your income's too high, you end up paying income tax on your Social Security. By using this tool, it doesn't impact your Medicare premiums and won't impact the requirement to pay income taxes on your Social Security because it won't be part of your income. Okay, any questions on that? Okay, the next one, if you have a low income, if your brackets are low, consider converting a portion of your traditional IRA to a Roth IRA. So if you're in the 15% bracket, or you have some room in that bracket, so you won't kick into a higher bracket, then convert some of your IRA at the low income tax bracket. So now it's in a Roth IRA, and in the future that'll grow, income tax free. Only do this, by the way, if you don't need that money to live on. If you're going to use that money to live on, then don't convert it and pay your tax early. But many people have larger IRAs than they need, and they'd like to not take out the IRA, but they're being forced to, but they're in a low bracket. So consider converting some of your traditional IRA to a Roth to take advantage of low income tax brackets. However, if you convert too much, again, remember what may happen is that your income tax rates, your income will be so high that it'll increase your Medicare premiums and also possibly subject your Social Security to Social Security tax. So be very careful on that. Okay, so I see a question. So let me see what that question is. I'm not sure what tool to use for that. I'm not sure what you're asking for that. So go ahead and re-ask that question and ask me and tell me exactly what you're referring to, and I'll try to answer that. Now, lastly, in the outline, I talk about the proposed tax legislation. And as I said, it's passed the House. I can't predict whether it's going to pass the Senate. I don't want to tell you, but the politics of right now going on, who knows if it'll pass. But if it passes, it has some changes in it. Now, what the House has passed is, number one, they're going to increase what's called the SALT deduction. That's the state and local income tax deduction. As I mentioned, right now, as part of the 2017 Tax Act, they limited the deductions that you could take for itemized deductions for income taxes, state income taxes, city income taxes, and local taxes to $10,000. The new legislation would increase it to $80,000, which will impact mostly the states like New York and California, where the tax rates are much higher. But people here in Ohio, when they add their property tax, their state income tax, their local income tax, they could definitely be above 10,000. They're going to increase it to 80,000 for the years through 2023, and I think possibly for this year, 2021. So that means, and then it would expire in 2031, but let's not worry about that till later. So that would be an advantage for many people, and also maybe make it easier for people to itemize. Okay, so the question was, what tool to use to figure out if you're going to take the bump in the Medicare premium? What I would suggest you do is go to the Social Security website. They have a whole website that gives you the income limits and whether you'll take a bump, and you'll be able to do the calculations with that tool. At least the last time I looked, that's what that does. They also have if you get a statement, your monthly Social Security statement, by the way, tells you the limits also. So if you get that in by hard copy, you'll be able to see that. If not, you go to your the online site of the Social Security, and you'll be able to see that. The next change, so a lot of the changes that they talked about, they didn't do anything with the estate tax. They did change something that doesn't impact most people, but I'll kind of mention it. There is a provision in the tax code that if you sell what's called C corporation stock, a small business, not a public corporation, you can avoid the income tax on 100% of the gain up to like $10 million. So this has been used by a lot of people who invest in startups and this, that, and the other, and they want to get rid of that. But now, and so this new legislation would get rid of that for high income people if it goes through. So if you're in that situation right now, you own some shares of the startup, and they're thinking of selling, or you're thinking of selling, see if you can accelerate it this year, because this may not be around next year. If you're still in business, operating a business, and you're an S corporation, if your income is above $400,000 for single people and $500,000 for a married couple, they're going to add a surtax of 3.8% on your profits if you're active in the business. If you're not active in the business, you're already subject to the surtax as a passive investment of 3.8%. So now they're kind of imposing it. It's almost like adding another Social Security tax on higher income people. So that's going to be part of the bill if it passes. Now, this next one, I just bring it up because it doesn't impact too many people. But if you have a very large IRA, more than $10 million, then they're going to, beginning 2029, they're going to require you to take any amounts in excess of 10 million out as a minimum required distribution. And they're also going to prohibit you from making contributions to retirement accounts if your accounts are larger than that. So that's not, I'm assuming that doesn't impact too many people, but I mentioned it because the idea was someone in Congress read a newspaper article about a number of people who have these humongous IRAs, especially some of the high-tech people who started PayPal, for example. He has like $1 billion Roth IRA, some fantastic amount. So they're going to make these people disgorge all that money, get it out of the Roth, which grows income tax free, and started being part of the tax system. And that's not going to kick in until 2029. I'm not really sure why they picked that time frame, but that's what they did. But that's not going to impact too many people. They also, if the law passes, they're going to get rid of the backdoor IRA beginning January 1 of next year. So that means if you want, even if you want to do one for this year, for 2021, you've got to get it completed before January 1. You have to convert it and put it in, you make your contribution to the IRA for 2021 and convert it to a Roth before January 1, if this law passes. So if that makes sense to you, then you ought to look at that, because you won't know, we don't know yet whether the law is going to pass, but you're not going to have a lot of time. And with the holidays, it may take a while for you to do that. Now, that's all I really have. Again, when I had planned this seminar, we'd anticipated a lot of new tax legislation and therefore a lot of tax planning we were going to talk about. But that's some basic year-end tax planning. I appreciate you attending this seminar. I know it's a shorter one than we usually do. We will send you out these outlines, if not today, the beginning of the week. And we do these seminars, every several weeks. So be on the lookout for our emails for upcoming seminars. And I'll hang around for a couple minutes to answer any of your questions if you have any other questions. Otherwise, thank you and have a good holiday.